And we're watching these shares of C3.ai that are getting a great boost today on a strong quarterly report. Our guests are with us for some perspective here. David Nicholson, Chief Research Officer of the Futurum Group, and Kim Forrest, Founder, Chief Investment Officer at Boca Capital Partners. Kim, I'll start with you. Some thoughts here. Do you love C3.ai? I mean, look, anybody who had it today, they're happy they see a 20% move. Did you like it before? Do you like it now?
Well, I kind of like it, and I like it because it's delivering the kind of AI that I really believe in. And what that is it analyzes little slivers of a business and then allows them to make it more productive.
Dynamics, potential, and risky. C3.ai offers a complex narrative that draws both excitement and caution. On one hand, the company stands debt-free and holds nearly 20% of its market value in cash, a solid foundation for growth. These financial strengths cannot be ignored and paint a promising picture for investors. Despite its apparent strengths, the company burns through approximately $1 in non-GAAP losses for every $4 of revenue it generates. This sharp contrast raises concerns about its financial efficiency and sustainability. The path to profitability is a long journey with no immediate turnaround. This reality casts a shadow over the company's glowing prospects, leaving investors to wonder about the future. With these factors in play, what will ignite the next surge of momentum for C3.ai? C3.ai specializes in enterprise artificial intelligence applications aimed at helping large organizations streamline their operations. It uses the full range of artificial intelligence technology, from basic infrastructure to advanced machine learning models. Their offerings include predictive maintenance, supply chain optimization, and energy management. These solutions enable businesses to leverage artificial intelligence benefits without building these complex systems from scratch. C3.ai's outlook looks strong in the short term, fueled by growing demand for artificial intelligence solutions. The company has seen notable revenue growth, with subscription revenue jumping 41% year-over-year in the fiscal fourth quarter of 2024. They've also expanded their client base across the federal, defense, and aerospace sectors, and interest in their generative artificial intelligence products remains high. However, C3.ai faces hurdles. The shift to a consumption-based model has led to a drop in average total contract value and decreased remaining performance obligations. This shift suggests a comparison to choosing between a pay-per-view and a Netflix-style subscription model. While one rewards frequent use with enhanced service, the other can lead to higher cumulative costs over time.
But the thing that I really like about them is their position in the greater panoply of tech companies. They, in my opinion, are going to be a ripe target for some of the mega players seeking to add the capabilities of a C3.ai to their portfolio. I think that's the big story.
On the other hand, C3.ai's forecast suggests strong growth ahead, with fiscal 2025 expected to deliver more than a 30% compound annual growth rate in revenue. This outlook represents an acceleration from the previous year, making it an exciting prospect for the company. However, there's a critical nuance to consider. The comparisons to the prior year are relatively low, which simplifies reaching the anticipated 32% growth in the fiscal first quarter of 2025. The real challenge lies in whether C3.ai can sustain these impressive growth rates as it faces more demanding comparisons throughout the rest of the fiscal year. In essence, the situation is complex for both optimistic and cautious investors. While C3.ai anticipates growth in the near future, its ability to sustain momentum against more challenging benchmarks will be crucial as it moves into the fiscal second quarter of 2024 and beyond. The evaluation of C3.ai stock is nuanced, with both positive and negative aspects to consider. On the positive side, the company boasts a balance sheet highlighted by approximately $750 million in cash and zero debt, comprising over 20% of its market capitalization. This financial strength alone makes a strong case against recommending a sell rating. However, significant concerns drive the negative outlook. Firstly, despite its growth, C3.ai's non-GAAP gross margins have contracted by 400 basis points year-over-year, which could limit its potential valuation multiple. As the company scales, its profitability does not improve proportionally, raising doubts about its long-term financial health. Secondly, even under optimistic projections, C3.ai expects to maintain roughly flat non-GAAP operating losses of around $90 million while targeting revenues of about $400 million. This disparity underscores the company's distant path to profitability, which could deter investors looking for sustainable returns. Ultimately, while C3.ai presents a compelling narrative in the artificial intelligence sector, investors may soon become more selective. The first thing to note here is that despite C3.ai's most recent rally, the stock still trades at modest revenue multiples. At current share prices near $29, C3.ai's market capitalization is just over $3 billion. Netting off the $753.2 million of cash against this market cap, we arrive at an enterprise value of $2.75 billion. Meanwhile, for the upcoming fiscal year 2025, ending in April 2025, C3.ai has guided to $370 to $395 million in revenue, representing 19 to 27% year-over-year growth. It's crucial to note that C3.ai anticipates accelerating revenue growth, aiming for a 23% midpoint increase. This marks a notable uptick compared to the 20% growth seen in the fourth quarter and the 16% growth achieved throughout fiscal year 2024. This is a clear indicator of a company that is just hitting its growth stride. And against the midpoint of this outlook, C3.ai trades at just 7.2 times its enterprise value. Also, it is essential to note that this is substantially lower than Palantir's multiple, the best peer example of a pure-play artificial intelligence software company growing at a similar pace. Equally noteworthy is that C3.ai is ramping its growth momentum, supported by smaller deals expanding its revenue streams across diverse sectors. Analysts foresee sustained growth, projecting a consensus revenue target of $467.1 million for the next year, reflecting a robust 22% year-over-year increase. Will C3.ai's current valuation multiples catch up to its accelerating revenue growth and industry comparisons in the coming fiscal year? Share your insights and comment down below. If you found this information useful, like and subscribe for more investing tips.
We just highlighted some of these deals that you signed last quarter. Just really a wide variety of companies. Give us a sense as you look ahead to the second quarter, where are you seeing the biggest demand? What sectors?
I'd say public sector is huge, state and local government, manufacturing, aerospace, telecommunication, consumer packaged goods. It's really across the board. We're now in construction materials at Wholesome in Europe. That's just a huge transaction going on there. So this is all about digital transformation. It's about applying AI to optimize business processes. It's about energy efficiency, ESG, decarbonization.
So Tom, it's about everything. It's about every sector and every industry.
Moreover, several critical short and long-term factors are setting C3.ai up for an increase in its market valuation. Firstly, the rise of generative artificial intelligence has significantly expanded C3.ai's market reach. As industries increasingly adopt automation, C3.ai benefits by providing crucial software solutions. Additionally, C3.ai's growing presence in government contracts, which now make up over half of its recent bookings, represents a profitable opportunity for expansion. The company's adoption of a consumption-based business model allows it to start small with clients and grow over time, similar to successful companies like Snowflake and Twilio. C3.ai's diversification across industries, from heavy manufacturing and oil to finance and healthcare, strengthens its market position and broadens its customer base. Lastly, strong partnerships with major cloud providers like Amazon AWS, Google Cloud, and Microsoft Azure enhanced C3.ai's ability to offer tailored solutions and reach a wider audience. Investors eyeing C3.ai may find it strategic to maintain positions during market upswings, anticipating potential valuation increases as the company executes its growth strategies. This approach aligns with leveraging C3.ai's strengths in expanding its market presence and enhancing its technological offerings. With these factors in play, the next surge of momentum for C3.ai could hinge on several key developments. Firstly, its ability to sustain and accelerate revenue growth as projected for fiscal year 2025 will be crucial. Secondly, overcoming challenges related to transitioning to a consumption-based model and improving profit margins could inspire investor confidence and drive the stock's valuation higher. Additionally, continued expansion into new sectors and strengthening partnerships with major cloud providers may further boost C3.ai's market presence and investor appeal. In conclusion, caution is warranted despite C3.ai's strong financial position, which includes no debt and substantial cash reserves. The stock's high valuation, currently at 9 times sales, and ongoing profitability challenges despite solid revenue growth raise concerns. Short-term prospects for C3.ai are positive amid rising demand for artificial intelligence applications. However, concerns persist regarding the company's shift to a consumption-based model and its shrinking profit margins. Given these considerations, a neutral stance on C3.ai stock seems prudent until more explicit evidence of sustainable profitability and scalable growth exists. C3.ai still holds significant growth potential, driven by its focus on artificial intelligence software platforms in a competitive tech landscape. Furthermore, trading at a lower revenue multiple compared to peers like Palantir while expecting revenue acceleration next year presents a compelling case for potential investors. Will C3.ai's strategic shifts and market strengths be enough to outpace its valuation challenges and drive sustained investor confidence in the competitive artificial intelligence sector? Share your insights in the comments below. If you enjoyed this video, you might also like our hand-picked, action-packed newsletter about AI and tech stocks such as Palantir. Subscribe now at wiseinvesting.com. And that's it. Make sure to smash the like and subscribe buttons down below. Additionally, if you want to know about C3.ai stock, just click this video here. Thank you for tuning in, and stay tuned for more exciting content in the future.